What's up, guys? I'm going to take a few minutes to just kind of go over the way that I view mitigations and basically how they're useful in the actual market. So, assuming that we'll call the darker line H4 and the pink line the M15, or what you could do is have the M15 as your black line and then have the 1 minute as your pink line. They would be the equivalent to each other, so it doesn't really matter. It's just utilizing the time frames together. So ultimately, we can see that this entire range is mitigated by this entire range is mitigated by this, and that gives us kind of like the higher time frame POIs. Let's talk about the lower time frame stuff so that we can get a good understanding of what it is that we look for and why it's useful. So basically, when you start to see like a supply chain happening, let's say there's a higher time frame demand zone sitting here like this. The idea is when we kind of compress in price and we start to see these repetitive supply chains being met, and then essentially get a liquidation of the low. Typically what's going to happen is we'll see our order flow shift or our change of character, depending on what you'd like to call it. But in the circumstances that we essentially sweep the low, break up, usually we're going to react to an unmitigated POI. Reason being is if this was mitigated and this came in like this would just pose a lot more equal highs, or mitigations is what we call them, that'll be ran as liquidity. So typically what will happen is we'll usually get hung up on something that is unmitigated, bring us back down into our newfound demand, push us forward, pull down, create inducement, which creates equal highs or a potential false supply chain to then keep pushing forward. On the flip side of things, of course, the higher time frame is the more powerful one, which is the black line here. But you can see now we start to build mitigations in the opposing direction, right? So once we start building these in the opposing direction, we create liquidity. So that's what supports our move. If and when we hit something obviously premiumly priced in the middle of the leg, come up, mitigate a unmitigated POI, essentially is what we're looking for, get liquidity sort of cleared out across equal highs. And then once we do that and we see the order flow shift, the reason order flow can shift is typically because of the buildup of passive orders or liquidity that's resting below a bunch of mitigations. All mitigations are a bunch of taps into a specific price zone that are very tight together, which creates a demand chain is how we sort of know it, and that creates a lot of orders underneath the lows, which is the reason why price tends to just kind of crash through the mitigation areas and then gets hung up on the areas that are not mitigated, right? So anytime you see a POI that's sitting here and there's been no tap into it from a previous price leg, the idea is that more often than not, this is the area that will prove to have a reaction and then get ran a little bit later on, right? So in terms of mitigations, like I said, the easiest way to look at them is basically a price in a structural leg, whether it be just a little 15-minute structure point, whatever it might be, but it's essentially just a structural point that has not been tapped into to mitigate the last of the orders that rest here. And what it does from here is essentially if there's more liquidity resting below these lows than there are after these highs, the idea is that this price will continue to go downwards, right? But in the case that obviously now we've maybe hit a higher time frame POI, whatever it might be, essentially what we're doing is we're now mitigating something. We're failing to break a structural point. We have a change of character, let's say in here on a lower time frame, whatever it might be, and then we can start to align this with the equal highs that are just created across mitigations, right? Because the more you mitigate something, the more passive orders that rest above or below it. And that's basically how I see mitigation. So just kind of walking through, again, left to right and just kind of going through the process a little bit further. Now this would be considered mitigated. That would create liquidity underneath this low, being used as a future move to be able to kind of crash through and, alongside with expectational order flow on the higher time frame. And yeah, like basically, yeah, demand chains forming right here, right? Getting reactions to unmitigated supply zones, failing to take out structure points, creating liquidity, run on the high. Once we take out all the equal highs, we tap into something that's unmitigated. We push down. We can now consider this mitigated, all of these mitigated. And as we sort of compress into price a little bit more and more and more, especially when we get into the more discounted areas of the leg. Ideally, we want to pair that with some form of higher time frame demand. This is a really good catalyst for us to start moving in this direction as we get that compression. So I hope that clears things up. I am going to post this for you guys to just have this as a document, but essentially the gist of it is unmitigated POIs are just areas that have not been tapped into to grab the remaining orders. And more often than not, they will produce the largest reactions to the market if they are unmitigated, and the ones that are already mitigated will typically be used to generate and clear liquidity across those mitigations.